Hello students. Till previous session we studied about assessment of individuals, calculation of total income of an individual and calculation of tax liability of an individual. In this session onwards, let us study about assessment of firms, that is total income of firms and calculation of tax liability of a firm. In this part, let us know what is assessment of firm and what are the key features of assessment of a firm. As you know, Section 4 of Partnership Act of 1932 defines partnership firm as relationship between persons who have agreed to share the profits of business carried on by all and any of them acting for all. It is association of two or more persons carrying a business or carrying an activity to earn profit, that is known as partnership firm, and here all of them may are working partner or some of them may working partner. Here it is not necessary that all the partners must be the working partners that you studied in your previous classes while studying the partnership firm. There are different types of partners in a firm and we are not going to study that in detail in this chapter. And persons who have entered into partnership with one another are called individually partners and collectively they are known as partnership firm. Name under which the firm is carried is known as partnership firm name. Here the important thing is to know about the key features of assessment of firm, that is calculation of total income and calculation of tax liability of a firm. The first feature of assessment of firm is the firm will be taxed as a separate entity. Tax must be imposed on the firm separately. It is separate from its partners. Partners will pay tax on their individual income and collectively they pay the tax on the income earned by the firm. That two things are different. Second feature is the share of income of partner in his hands is fully exempt from income tax under section 10 subsection 2a. Any share of income or a share of profit of a partner in his hand is fully exempt from tax. That income from partnership firm is exempted from tax, that is profit from partnership firm, that is tax free income, that we studied while discussing the assessment of individuals. There you paid tax on the remuneration earned by the partner from a partnership firm, but the share of profit from partnership firm is exempted from a tax under section 10 subsection 2a. Next see, any salary, bonus, commission or remuneration to partner will be allowed as a deduction in computing the total income of the firm under section 40 subsection B. It will be allowed only when such partner is a working partner. Any salary, bonus, commission or remuneration should be allowed as a deduction while computing total income, as these are the expense to the firm and it is taxable in the hands of partners individually. And for allowing deduction for salary, bonus, commission or remuneration, such partners must be working partners of the firm. In assessment of individuals you studied salaries, remuneration, bonus, commission, anything earned from the firm is taxable in the hands of individual and in the firm it should be allowed as deduction. Why? Because these are expense to the company. Here partners are working for the company, they are working as working partners and any return given to them must be deducted from the total income of the firm as expenses to the firm. This is the third key feature of assessment of firms. Next one, see, where a firm pays interest to any partner on its income, maximum rate of interest allowable for deduction is 12% per annum. Any interest is payable to the partner on the income of the firm, interest is allowable to the partners, but for deduction purpose they can claim only up to 12% per annum. If they are paying any extra income, extra interest on income to the partners, for example they are paying 15% interest per annum for its partners, but they can claim for deduction only up to 12%. For the extra 3%, that is 15% minus 12%, for that extra 3% they have to pay tax. They cannot claim that extra 3% for deduction, because maximum rate of interest can be allowed for deduction is only 12% per annum in a partnership firm. Next feature, C, the effective rate of tax is 30%. In assessment of individuals, there are various rates of tax up to 2,50,000 or next 2,50,000, that is 2,50,000 to 5 lakh, 5 lakh to 10 lakh and 10 lakh and above. There are various rates of tax, but in case of firm, the effective rate of tax is 30%. They have to pay 30% tax on their income in every year, that is for every financial year. Next feature is, if the total income includes long-term capital gains, short-term capital gain taxable at 15% and lotteries etc., that is income from casual income, that is lotteries, crossword puzzles, horse race etc., they are taxed at the special rates applicable to them. Here you have to apply the special rates like your assessment of individual. In this case, income from a lottery etc. is given, that includes all casual incomes they earned from various activities. For that you have to pay at the special rate. For example, long term capital gain at the rate of 20% or 10% as the case may be, and short term capital gain taxable at 15% etc. For that there is special rates, and here you cannot apply the 30% on these three incomes. Next feature, C, surcharge at 12% is levied if the total income is above rupees 1 crore. In case of assessment of individuals, there are different rates of surcharge, that is above 50 lakhs 10%, above 1 crore and below 2 crores 15%, above 2 crores 25% and above 5 crores 37% etc. But in case of assessment of partnership firm, surcharge is levied at the rate of 12% on total income if the income of that firm is above 1 crore. Remember this point, tax rate at 30% and surcharge at the rate of 12% if the income is above 1 crore in case of partnership firm. Note down that 2 points. And health and education cess is levied at 4%, that is same for individuals as well as for the firm. Health and education cess at the rate of 4%. And firm is subject to alternative minimum tax at 18.5% of adjusted total income. This alternative minimum tax AMT at 18.5% inclusive of health and education cess, that is 18.5 plus 4%, that is you have to add that 4% to this 18.5% to calculate AMT. That let us study in the next session in detail. For firms, remember this point, you have to calculate alternate minimum tax. For companies, you are calculating MAT, but in this case, that is firms, you have to calculate AMT at the rate of 18.5% on adjusted total income. Adjusted total income and what it includes and how to calculate this AMT, let us study in the next session. So, this is about the key features of assessment of firms. There are 9 features. Go through these features once again. Thank you. Let us meet in the next session.